During hyperinflation, when inflation spirals out of control, or deflation when prices start falling, your stock investments can be destroyed. Had you invested in the US stock market at the peak of 1929, your investment would have lost 90% of its value over the next 2 years. Your portfolio wouldn't have fully recovered until 1955, 26 years later. That can be a very painful experience. How do you know that a deflationary depletion, which caused the market crash in 1929, won't happen again? How do you know that hyperinflation won't happen again? Since ugly economic events like this can happen when stocks take a big hit, should you even invest in stocks? Let us find out. The investment advice you'll get if you ask the smartest and the wisest investors like Warren Buffett or bloggers like J.L. Collins, who wrote the famous stock market series, is that you should invest in a diversified low-cost index fund for the long term. This advice sounds like wise advice, but is it practical? Is it possible to watch your investment fall by 90% and not get scared, even for the most stoic among us? How can we wait for 26 years? What if we need money now? In the long term, all of us are dead. Whether to invest in stocks or not depends on how much risk you're willing to accept in the process of wealth building. Looking at the past 120 years, you have to ask yourself whether it makes sense to focus on rare economic disasters or on the fact that they have relentlessly gone up. In order to make an informed decision, let's try to understand these two types of economic disasters a bit more. America experienced a painful deflation between 1930 and 1933 when prices dropped by 7% yearly. More recently, there was a recession in America, a milder form of depression, between December 2007 and June 2009. During that time, commodity prices, particularly oil, fell because of weak demand. Japan has been struggling to fight deflation for more than 2 decades now. Why can't this happen in America again? Why is it good advice to invest in stock markets when we know that deflation totally kills the stock market returns? Deflation is the opposite of inflation. Prices of everything keep falling year after year. You might wonder, why isn't that a good thing? When prices of external hard drives or microchips, for instance, fall year after year, it is a cause for celebration, isn't it? There are two kinds of deflation. It is not the good kind of deflation that is worrisome, where technological advances make things cheaper. It is the bad kind that happens because of weak demand and excess capacity that is a cause for worry. If it becomes entrenched, deflation is more dangerous than most forms of inflation. When prices fall, consumers put off their purchases in anticipation of even greater bargains later, locking the economy into a vicious cycle of weak spending and sliding prices. Suppose you are considering a new house of late and notice that prices are dropping. It makes sense to wait so that you can get a better deal in future. If enough potential buyers join you, prices drop further. Delay is further rewarded and action is punished. Too much of this can cause the market to slip into a deep spiral of crashing prices. Deflation also increases the real value of money and debt, making it harder for governments and other debtors to repay debt. Deflation is also harder to fight than inflation. Japan had to pay a very heavy price for this. While the economy remains prosperous, safe, and comfortable, it remained stagnant while the rest of the world got richer. Average annual wages in Japan have raised a mere 3% over the past 30 years. Not 3% per year, mind you, 3% in 30 years. For comparison, during that period, the average wages in US have gone up by 47%. Japan's stock index, Nikkei 225, is still more than 26% below its peak in December 1989. Even though deflation is bad for stock markets, wages, and the economy, it's not very bad for 5 reasons. You wouldn't have had to shoulder the total weight of the crash and wait for 26 years to fully recover your initial investment unless you were exceptionally lucky and invested precisely at the peak in September 1929. If you had invested in 1926-27, halfway up on the climb to the peak, you would have lost all of your gains, of course, but you would have recovered your initial investment in only about 10 years, not 26 years. Although another rough patch was coming, many investors entered the market at this level. Suppose you had bought at the earlier peak in 1920. You would have taken an immediate hit and recovered 5 years later. From the collapse of 1929, you'd be back in 7 years by 1936. So even though it's widely quoted that the market lost 90% of its value, probably very few actually incurred that big a loss. Most investors would have faced a much smaller loss than 90%. Imagine someone just out of school and beginning their career in 1929. Assuming they were in the fortunate 75% who had kept their jobs, they would have had decades of opportunities to buy stocks at bargain prices. So a stock market crash at the beginning of your investing life is a gift. Even if you retired with $100,000 in 1929 and lost 90% of it because of the stock market crash, because of deflation, the purchasing power of the remaining $10,000 would have been much higher. No doubt it is a terrible situation to be in, but it is also an opportunity to grow the $10,000 very sharply had you invested in the stock market. Finally, it is essential to realize that a crash of that magnitude is very rare. It happened only once in the past 122 years. The next big crash happened only in 2009, that is 80 years later. And when that happened, the government learned to handle it much better, which is why the stock market recovered after the 2008 crisis in only about 4 years. As long as you don't buy stocks on the margin with borrowed money as many speculators in 1929 did and got completely wiped out, you'll be fine. And you'll live another day to ride the stock market on its way up. And there will also be clear signs that something terrible will happen. You will read and hear about people routinely making fortunes in an aggressively rising market using margin. Joseph Kennedy, the father of John F. Kennedy, is said to have known it was time to exit the market in early 1929 when he started getting stock market tips from his shoeshine boys. When you see such a sign, sell some of your investments and take chips off the table. Because once the crash comes, it'll be too late. Deflationary depression like that of 1929 is not the only possible economic disaster that can destroy wealth on a major scale. The other is hyperinflation. Hyperinflation is inflation gone totally out of control. Prices increase so much that the previous month can seem like a golden age. Officially, it's defined as a period in which prices rise by more than 50% a month. The phenomenon is rare. There have been 57 documented cases in history, of which Venezuela is the most recent. Because of it, Venezuela's currency, the bolivar, has lost 99.9% of its value in a short time. Hyperinflation often happens in the backdrop of a revolution, war, or political transition. The first recorded episode occurred between 1795 and 1796 in revolutionary France. There was a cluster of hyperinflation in Europe after the First World War, notably in Germany in 1920s. In fact, many historians think the Nazis came to power in 1930s because of the hyperinflation Germany suffered. America hasn't had to deal with this monster since the Revolutionary War way back in 1776. The recent cases of Venezuela and Zimbabwe show that war and revolution are not always the setting. Economic shocks such as a slump in oil prices, as in the case of Venezuela, or slump in farming output, as in the case of Zimbabwe, could also trigger a chain of events resulting in hyperinflation. The first thing that happens is tax revenues evaporate, leaving a hole in public finances. The government fills it by printing money. The increase in supply of money pushes up inflation. That is bad enough. But what accelerates the process, turning a jump in prices into hyperinflation, is the printing of money by central banks to finance the budget deficits of the government. It is essential to recognize that though hyperinflation is terrible news, every bit as destructive as deflation, a little inflation can be a very healthy thing for an economy. Just as delaying of purchases is rewarded by deflation, inflation incentivizes early purchases. Anything you want to buy will cost more tomorrow than today. That keeps the wheels of the economy greased and encourages spending over savings. A little bit of inflation is the antidote to looming deflationary depressions. This is the reason why the Federal Reserve has been working overtime, pumping money into the system these past few years through quantitative easing. challenge that Federal Reserve faces now is to ensure that there isn't too much inflation. It's a constant balancing act that the Fed sometimes gets wrong, as it recently did when it allowed inflation to reach 9% a year. Governments love a little inflation. It allows them to keep the economy humming. A humming economy can generate tax revenues for the government, allowing it to spend on politically popular social programs. Inflation also allows the government to pay back their debt with cheaper dollars. During times of inflation, money loses its value. So it's better to have your wealth in tangible assets like businesses, which is what you own with a fund like VTSAX. Stocks, by the way, are a pretty good inflation hedge, as long as it's moderate and built slowly. Given all this, it's not hard to see inflation being a constant feature in our lives. In fact, it's more likely today than deflationary depression. Over the past 120 years, stocks have risen relentlessly, but there also have been a few ugly economic disasters, such as deflationary depression and hyperinflation in other countries and in America. Your optimal investment strategy depends on the economic environment. During a deflationary depression, the best asset to hold is cash and bonds, as the real value of both increases. Stocks are the worst asset to invest in. But during hyperinflation, the best asset to invest in is gold. Since it is hard to foresee these economic shifts, every passive investor must decide how much risk to accept in wealth building process. The question is, do you want to build your investment strategy based on the possibility of an exceedingly rare occurrence, or the fact that stock prices have risen relentlessly since the 1800s? I am more comfortable being in the same boat as Warren Buffett and betting that the US economy, or any other economy for that matter that has consistently done well, will continue to be a winner. None of this is to say that big ugly events are not very scary or destructive, but they are very rare and they are survivable as long as you spend less than you earn and you avoid debt. If you like this video, I recommend that you watch this one. That video is about 4 mistakes every stock investing beginner can avoid, such as buying high and selling low, overconfidence, and others. I'm Sharat Mantravadi. Thanks for watching.